Headline, September PPI coming in above expectations. Join us now with a look at how the Fed will likely view this number. Former Dallas Fed President Robert Kaplan is the co-chair of the Draper Richards Kaplan Foundation. Good morning to you. I'm putting you back in the room with Jay Powell on this morning. You just saw the numbers. You know the context and the background of where we are. What would you be telling him?
I would still probably do nothing in the meeting that's coming up in November. And the reason for that is we've had a very substantial tightening away from the Fed in the Treasury curve, and that will serve to tighten financial conditions. However, I do think inflation is going to be sticky, and it'll be sticky getting below 3%, and we have to leave the option open that we may need to do more in future meetings. But I would kick the can and skip the November meeting.
So you skipped the November meeting. When you look 12 months out, though, now, and you're talking about inflation continuing to be sticky, how sticky are we talking? I mean, there was an expectation even a month or two ago that we could see the Fed, lowering rates within the next 12 months, at least on the other side of it. But it increasingly feels like that's very unlikely to happen.
Well, it's still possible that could happen. We've got a couple of significant structural issues that the Fed is working against. One, we've got decelerating workforce growth. In other words, we don't have enough workers. And at the same time, the government is spending aggressively on the Inflation Reduction Act projects, Infrastructure Act projects. There's still substantial unspent ARPA money that's being spent this year and next year. That is stimulating demand for workers. So while workers' savings may be declining, their incomes are strong, and I think they're likely to stay strong. The consumer is going to probably surprise the upside, and the job market is going to be resilient. And the other structural issue we've got is a structural undersupply of oil and gas. And while we're aggressively trying to make a transition to wind, solar, and alternatives, and I think we need to do that, we still got a lot of demand globally and in the United States for fossil fuels. Workers need usually to drive a car to get to work, and they need to get paid more if they're going to put gas in the tank.
Can you layer in this heinous attack on Israel that took place over the weekend and how that will relate or not to any of the kind of conversations that you think happened in the room?
Well, anytime you have a horrible event like this, and also the prospect of widening, of escalation, I think it creates a lot of uncertainty. And I think when you have uncertainty and you don't know how this is going to unfold, the wisest thing to do is to stand back and not take action and let it unfold. So I think these recent events, horrible events, are more likely to augur for take no action than to take action.
I want to bring you back to last Friday, jobs report. We had a hot number, total number, in terms of employment or unemployment. But then when you started to look through it, people got a little bit more comfortable with it because they didn't think the wage inflation wasn't going up as much. You didn't see a cutback on the hours worked in the way that I think some people had been anticipating. Do you take that as a positive? Was that a hot number to you? What number was that?
It was a number to me that showed the cross currents in the economy. Away from government spending that's fueling demand for manufacturing projects and manufacturing construction workers and infrastructure projects, the economy is softening. And if it weren't for the government spending, I think it would have softened further by now. And I think we'd be a lot more confident that the Fed would be done raising rates. But maybe what's not being talked about enough, we have substantial amount, as I've said before, new manufacturing projects, usually public-private partnerships with the Inflation Reduction Act, infrastructure projects. They need workers, and they fuel demand for workers. And so what's happening around the country when I talk to companies, and particularly service sector establishments, they're competing with those projects to attract workers and to keep their existing workers. And so this dynamic, appears like it's going to continue through the end of 23 and into 24. And I think these cross currents, I think a little bit were reflected in that number. And you saw the footprint of government-related spending also in that number.
We had Paul Tudor Jones sitting at this table just yesterday, and he said a recession is almost invariably in the cards. This idea of a soft landing, at least I think, I don't want to put words in his mouth, I think is just, in his mind, something that is almost it's almost a plane that's impossible to land. Do you agree with that at this point? Yeah,
I think the issue is when. And I think, again, without the large deficit spending, and again, we just have gotten, for the year that just finished, we ran a touch below $2 trillion deficits. That's historically large, post-crisis, pre-recession. Normally you get those kinds of deficits in a recession. We're getting them now, and I think that government spending is kicking the can a bit or forestalling when a downturn will happen. But there's still going to be a downturn, particularly when the government spending dissipates. I think my only question is, it may happen later than people expect.